Okay, a very good evening, ladies and gentlemen. I am Jason Fu, the Dealing Manager of ETF Desk in Phillip Securities. Tonight, we're very happy to have Mr. Robin here with us to talk about the investment case for gold and the outlook for gold. Before I introduce the speaker for tonight, maybe we just do some simple question to get the ball rolling, right? So let's do a quick survey before we go into the webinar proper for tonight. May I know how many of you have already invested into gold? Please type gold, G-O-L-D, into the chat, and then let's see what's the response like. So if you're invested into gold, type in gold. If not, you can type in NO for not investing at the moment. Right, okay, I can see quite a lot of spontaneous answer from a lot of you. It's quite even as of now. Okay, and a lot more saying no. That's the reason why all of you are here tonight. Okay, it's a very good kind of audience we have. Some are already invested in gold mining, ETFs, and most of you are not invested. So very good setup for tonight's webinar. Right, for those that are invested in gold already, maybe you can just share with us what are the gold instruments that you are already investing in currently, like gold ETF or physical gold, jewelry, unit trust, and so on. Right, ETF, yes. It's actually one of the most common or easier way and cost-effective way to invest into gold. Some are invested into gold mining companies. Yeah, okay. All right, Ken, thanks again for your very spontaneous reply, everyone. Okay, without much ado, let us welcome our speaker for tonight. Okay, Mr. Robin Sui is the APAC Gold Strategies and Gold Sales Specialist for State Street Global Advisors. He supports the institutional and intermediary sales efforts in APAC to increase investor awareness of SPDR Gold ETF. Robin, please.
Thanks, Jason. Good evening, everyone. Just allow me to share my presentation. Okay, I hope everyone can see my presentation. So as Jason mentioned, I'm the APAC Gold Strategist at Spider ETFs for State Street Global Advisors. For those who are not familiar with our firm, we are the 5th largest asset managers in the world with about 4 trillion of AUM. And we are actually the largest provider of gold ETFs in the world as well, with about $60 billion US. Tonight, I'm very delighted to speak about gold. I know it's quite late this webinar. I'm very happy. I'm seeing so many attendees have joined. So everyone here must be, I guess, interested about the gold outlook. And I saw some of the replies as well. Most of you have allocation to gold. So tonight I'm going to share with you, for those who hasn't invested in gold, the case for gold, why investors like us, individual, institutional, pensions, and central banks invest in gold. And also I'm going to provide an outlook for the gold market heading towards the year end, and also next year for those who might be interested to buy or even sell in the coming months. So tonight's webinar, I know I've been given about 45 minutes to speak, and I'll definitely leave some time for Q&A. The first part, I'm going to go through the case for gold. So as I said before, why investors in general like gold as an investment. The second part of our presentation will go through the portfolio strategy, meaning using gold as a strategic asset to improve your overall portfolio. Because when we talk to investors around the world, from institutional, pensions, private banks, they don't look at gold alone as a single asset, but they include gold in a multi-asset portfolio that gold can play in terms of how it can hedge against market risk, and also how gold can actually improve the returns of your overall portfolio. So we spent some time looking at that as well. And before the Q&A, I'll go through the market outlook and review for 2021 and 22. Okay. So when you think about gold, so it's just a question to all the audience. What do you think about? What do you think gold is? Do you regard gold as a commodity? Sorry, I'll flip the slides. Do you regard gold as a commodity? Do you regard gold as a precious metals? Do you regard gold as a real assets or a currencies? Because when you look at gold as a whole, it's quite a unique asset, given it acts like a commodity, it acts like a precious metals, it acts like a real asset, but at the same time, it acts like a currency because it's freely traded like a US dollar or Singapore dollars. So when you look at the similarities between gold with commodities, precious metals, real assets, they have a few things in common, such as they are good inflation hedge, which means that when you buy gold and commodity and silver, usually in a rising inflation environment, gold will actually outperform other asset classes in line with other commodities. It's like a currency because, as I said before, it's very liquid as well, and it's a free-floating currency where investors like us can trade on a 24-hour basis. It's like a real asset as well. So you think about your properties or your natural resources, equities. Gold behaves quite similar to those asset classes as well because they are a very excellent inflation hedge as well. But I want you to focus on the key differences of gold versus commodities, precious metals, real assets, and currency. Because if we compare gold to commodities, for example, the demand and supply is actually quite different. For example, if we compare gold to copper, the demand is actually quite different, where gold's demand is driven by sectors that are actually not related to each other. So I'll go through that in the next couple of slides. Many people will ask, silver and gold is quite similar because they're precious metals. In some form they are, but gold is more unique in the sense that gold is actually bought by central banks around the world. And gold is the only precious metals or commodities.
Hi, sorry, Robin. The slides, are you controlling the slides?
Yes. Can you see?
Okay. It's still on the first slide, the title.
Oh, that's strange. So you can't see my movement of the slides?
Yes, correct. It is on the title.
Okay, sorry about this. Let me close this and.
Okay, looks good now.
Okay, maybe I won't expand the.
Thank you.
So you can see my slide, Jason?
Yes, all good now.
Okay, sorry about this. I didn't know the slide didn't work. So as I mentioned before, this table actually categorizes the differences and similarities between gold and commodities. I will make the slides available for Phillips Securities. So if you want to look at this table, look at the comparisons, feel free to, but I won't spend more time on it because I know I just probably spent 5 minutes talking about these slides. So the case for gold, for those who are not very familiar with gold as an asset, institutional investors, very large investors around the world actually view gold as a strategic asset. What we mean by strategic asset is that they consider gold as a long-term asset they will put in the portfolio over the long term because they understand that gold plays a very vital function in their overall portfolio management function. So what gold can bring as an asset class? First of all, it provides diversifications. These 4 points I'll go through in the next couple of slides, but I just want to provide a summary to everyone here so you have an idea what I'm going to talk about in the next 5 or 6 slides. The first most important is diversification, which means that gold has a very low correlations to many other asset classes. When I talk about correlation, which means that gold on average over the past 50 years do not move in line with other asset classes like equities and bonds. So if you have a large exposure to equities and you want to hedge your potential downturn in your equities allocations, gold will be a very effective hedge. So that's why gold, when you hear on the news or people talk about gold, it's considered as a safe haven because when the market experiences downturn, it will help you to diversify. The second reason why gold is a strategic asset because it actually provides a very decent return. And for those not familiar with gold, you might be surprised that gold over the past 50 years on average will give you a return of about 7.71% on capital appreciations. And that's quite decent when you talk about gold because gold doesn't pay a yield, but at the same time, it has very limited credit risk as well when you buy gold because it's not controlled by the government. So when you think about gold as a kind of like a risk-free asset, 7% compound average growth is very decent. So gold pays a very decent return. And the third reason why institutional investors hold gold is that the liquidity it provides. When I talk about liquidity, gold is one of the most traded asset classes in the world. So which means that when you have gold in your portfolio, you can easily transact gold. And for some investors, that's one of the most important attributes that investors can look for because having that ability to sell and buy is very important. Unlike some other illiquid assets that you might need to buy and sell at a very high premium or high spreads. And lastly, when we wrap everything together, as I mentioned before, gold has a very excellent impact to your portfolio, which we will demonstrate later. So when you add gold in your portfolio, it actually improves your overall portfolio returns and volatility, which is the movement of your portfolio. So before I dig down into the four reasons, I guess the factors in more details, when you think about gold, what drives gold prices and gold demand? And if you look at the table on the left, those four sectors actually drive gold demand: jewelry, industrial, investment, and central banks. And when you look at the drivers or sectors, they are actually not related, which means that when you talk about jewelry demand, industrial demand, on average, that contributes about 60% of global gold demand. Jewelry and industrial is very seasonal, which means that it's cyclical driver, which means that during economic growth or positive business cycles, jewelry and industrial demand will actually increase the usage of gold. For example, if the economy goes well, I'll probably buy more gold jewelry. People get more, or there's more weddings happening, so the gold consumption will actually increase. Industrial as well, because industrial means that your iPhones or the computer I'm using right now use gold as well as a conductor. So during a economic growth cycle, those two sectors will actually drive gold demand and prices. But at the same time, when we experience a market downturn, that's where investment comes in. Over the past 10 years, about 30% of gold demand is driven by investment. So when you talk about gold as a safe haven, during a market distress or uncertain times, gold demand will actually increase through the investment sectors, which we actually saw last year, where during the COVID situation, there was a record investment into gold bars, into gold ETFs, because people were worried about the economy. But although this year we see some outflows from gold from the investment sector, but that has been offset by jewelry, because if we're talking about jewelry this year, it's actually increased because the economy is picking up in China and India. And lastly, as I mentioned many times before, central banks, it's a huge buyer of gold. Gold is the only commodity that central bank buys. Central banks buys about or contributes about 10% of the annual gold demand on a yearly basis. And who buys it? The Bank of Thailand, Singapore, all the emerging market central banks are buying tons of gold because they need gold as a hedge against market uncertainty. So if we wrap everything together right now, if you ask me what the 3 key functions that gold can play, 1 is the risk management function, 2 is the capital appreciation function, and 3, the wealth preservation functions, which can be tied to the 4 factors or drivers why people invest in gold. And in the next 6 slides, I will go through the usage or the attributes in more details. So when I talk about gold as an effective risk management tool, or gold provides diversification, as we can recall in the last couple of slides, why gold can provide an excellent diversifier for your portfolio? Because of this low correlation concept that I'll talk about. When an asset class have low correlations to other assets, it does not move in line with other asset classes. So if you look at the chart here, having a correlation of 1 means that 2 assets move in line with each other. So if A moves 10%, B will move 10%, up 10%. If the correlation is -1, means that asset A moves 10%, asset B moves down 10%. So the perfect hedge. So the chart here shows you gold's correlations to some of the major equities and bonds. I just want to put your focus into the US equities in the 3rd column, because US equities is the largest market in the world. So most institutional investors trade US equities. And if you look at the 30-year correlations, it's actually close to 0, which means that if tonight US market goes down, gold will probably not go down, but will go up on average because of these low correlations. So this is the #1 factor why large institutional investors or institutions around the world invest in gold, because of these low correlations to other asset class that cannot be offered by other traditional asset class like bonds or even equities or alternatives. From our perspective, I think gold is one of the most effective hedge against equity market downturn based on our research and the past 50 years of data. A classic example, I want to show you how gold can react or provide an excellent, I guess, diversifier against market downturn, is to look at the last, I guess, 10 market downturn, major market downturn in the US. So if you look at the chart here, what we've done is graphed the last 10 major US equity downturn that have gone down more than 15%, ranging from the left in 2018, the global financial crisis, the COVID-19 market correction, Black Monday, over to the right-hand side, the trade war recessions. And this is based on 30 years of data. And if you look at every time the US market corrects more than 50%, gold will actually outperforms. I think that's very important, outperforms the US equities. And also, if you look at number of times that gold has become or able to register positive returns, it's about 7 times out of the 10 times. So because of these low correlations, every time that the market corrects over 15%, gold will actually protect your portfolio. Now, from our perspective, we're not sure when the market will correct, because if we look at the US equities, the global equities, it's still, the sentiment is still quite resilient when we're talking to investors, but we do advise investors to just hold on some gold to hedge the potential US equities. Because if you look at US equities, we have been in the 14-year straight bull market and we're trading record highs, okay? And it's a matter of time, I think the US equities will correct, but I'm not sure when. But that's why we advise to have some allocation to gold just to hedge against the potential downturn. Now, gold as a so I talk about gold as a risk management tool and also how it provides the diversification to your portfolio. Now we'll dig down into the returns. So when we talk about returns, we mean the capital appreciation potential of gold, because everyone knows that gold does not pay a yield. And actually, that's a reason why gold doesn't pay a yield, because it has very limited counterparty risk or credit risk. So you expect a high yield asset to have very high credit risk. So a lot of people question why I should invest in gold because it has no yield. But the fact, because the credit risk is very limited. So that's why the yield is not high. There's no yield at all. So I hope for those might be wondering why should I invest in gold because there's no yield. I hope you can look into the capital appreciation potential of gold, because on a yearly basis, gold that does appreciate a lot, because as we recall, there's many different drivers that drives gold: jewelry, technology, investment, and central banks. So if we go through different cycle throughout the last 20 or 30 years, there will be factors that will support gold prices. So if we look at over the long term, for example, if I dig down the 20-year horizon, over the 20-year horizon, on average, gold is actually the best performing asset classes when I look at its performance, 9.8% per year versus bonds, cash, global equities, and commodities. And 30 years very comparable to other asset classes. So 5.4% over 30 year. You might be looking at the 10-year. Why is it only 1.7? That's because gold is trading about, well, close to 1,800 right now. And exactly 10 years ago, it's the bull market, or gold just reached 2,000 because of the GFC. So that's why in the last 10 years, I guess the performance on a yearly basis hasn't been that great, because as we recall, during 2015, during 2013 and 15, gold actually went through a 3-year bear market. So that's why when you look at a 10-year horizon, you might be thinking 1.7 is actually quite small. But if you look back to last year alone, gold actually registered 25% return. This year it's down 6%, but I think, which I will share in a moment in the next couple of slides, I think right now, I think it's a great moment to accumulate, which I'll provide more reasons. But I think the key message here is that over the 20-year, which is a longer horizon, gold actually outperforms most of the asset classes that we track, especially against global equities as well. Now, gold, it's a very effective wealth preservation tool. So if I can tie this back to the liquidity factor that I mentioned on slide 3, is that gold is one of the most traded asset classes in the world. And this is something institutional value a lot, because if you talk to institutional investors about trading in asset classes, the one thing they look at is the trading volume on a daily basis, because for them, the ability to get in and get out of the asset class at ease is very important for them. And if you look at the right chart, you can see that gold, it's the 6th most traded asset classes in the world. It actually trades about 150 billion US dollar a day. And it's very substantial, because if we compare that to, for example, the German bonds, the Dow Jones, or even some of the currencies, it's actually very, very well traded. So that's why gold, I know I said it many times, it's a safe haven, because if you want to get into gold during market distress, you'll be able to get it at a reasonable price, and the spreads over that you purchase will be quite fair because of this trading volume. And if you need to sell gold during market distress, you can get out because of this trading volume. Because I understand, during the financial crisis, a lot of investors couldn't get out when they hold liquid assets like rigs or properties or infrastructure. So that's something I think we should all value, because I know that going forward, there will be a lot of market volatility because of this, all these market risks, unprecedented market risks that we're facing. Liquidity will be one of the key that investors look at going forward when they trade gold and also financial assets. But I think the number one or the most important factor why gold is excellent wealth preservation, it's its ability to hedge against inflation and currency depreciations. So even though I think liquidity is very important, but I think for us, for a retail investor, individual investor, why gold is attractive, because during a high inflation environment, gold will actually outperform equities, and does very well during a high inflation environment in the past. So if we focus on the left-hand side, which we look at some of the inflationary environment that we had, we're focusing on the US because the US inflation actually has the most impact on gold prices, because gold price is priced in US. But if we look at gold prices since, the performance since 1971, when gold actually became a free floating asset, gold does very well during a high inflation environment. So when the US CPI, it's over 5%, which we are actually experiencing right now. Last week, the US CPI is about 5.4%. On average, gold price will post 15.4% annual return. So that's why when you hear about inflation, you always hear about gold, because gold, it's a commodity. So during a high inflation environment, gold will able to react to the inflationary pressures, because gold needs to be mined, it needs oil to be produced, it needs labor. So when when all the cost is going up, that will usually push gold prices higher, which we have seen in some months this year, and also in the past as well. So I think from our perspective, I think inflation will remain quite high going into, last quarter and next year. That's why we advise clients to have some gold just as a hedge against inflation. Another important factor I mentioned is the currency depreciation hedging ability. Because gold is a currency, it acts like a currency. It's freely traded, and then you can trade gold in all the major currencies as well. You can trade gold with US, Singapore dollars, Vietnam-based Hong Kong dollars as well. It's a free floating asset. But if you look at the chart on the right, you can see that gold actually held its value against all other major asset or currencies. From our perspective, because of this unprecedented money pumping by central banks around the world, we believe currencies will continue to depreciate. And that already happened during the financial crisis, where central banks are pumping a lot of money into the system just to drive growth. Even though I think the Fed, that's the most important, will start to taper. But the fact that the Fed's debt level is actually quite high. So if you look at the amount of debts they own, or the amount of new money they have printed in the past, especially since last year, it's actually quite significant. So at State Street, we believe the dollar, which the world trading currency, will continue to depreciate going forward. And from our perspective, that will benefit gold prices going forward. So I think that's very important for investor. If you have exposure, I'm sure everyone has exposure to currencies, have some gold, because over the last 100 years, it has proven that it can hold its value against fiat currencies, as you can see from the graph on the right. Now, we we sort of talk about the case for gold. So if we want to summarize, is the returns, is the diversifications, is the liquidity, and also portfolio impact. The portfolio impact we're going to look at now. So we'll look at how gold will actually improve your portfolio performance over the long term. So this chart just looks at, again, the correlations of some of the major alternatives that investors own. So when I talk about alternatives, which means that it's other asset classes rather than stocks and bonds. So private equities, REITs, hedge funds, commodities, and gold. And we're looking at the correlations to the MSCI World Total Return Index, so which is the global equities return. And if you look at the correlations of gold compared to other asset classes, it's actually very low. So if you're thinking about buying, for example, investing in private equities as a diversifier against your world equities or equities, it might not be effective because the correlation is actually quite high at 0.8. Again, if you have commodity exposure, thinking about commodities will actually provide a very, very effective diversifier or diversification against your portfolio or market downturn. The actual correlation is actually quite high at 0.6. But if you look at gold correlations, it's somewhere between 0.1 and 0.2. So as we can recall, the lower correlations, the better the diversifying quality of the asset classes. And in fact, if you look at gold, the correlation actually became lower since 2009. So if we look at gold's correlations in 2008, it's actually around 0.2. But as people invest more in gold, and also gold behave very differently to other asset classes, which you can see from here, gold correlations have actually been lowered since 2008 at 0.1, which is a very, very low number if you want to use gold as a diversifier against your portfolio. Now you may ask, what's an ideal, I guess, allocation to gold? Because you can have 5%, 10%, or 100% into allocation of your wealth into gold. Before we go into more details, I just want to show you very basic, I guess, model or back testing that we did for some of our clients. So what we're seeing here is that we built 5 different portfolios: conservative, moderate aggressive, and aggressive. And for this portfolio, we allocate certain amount of equities and bonds into the portfolio. So if we look at conservative, we have 20% of global equities and 80% of global bonds in the blue allocations. For aggressive, we allocate 85% in equities and 15% in bonds. And we ran a model assuming no allocation to gold. And over the past 30 years, what's the maximum loss that the portfolio can register over the last 30 years? So if you look at, for example, the conservative, the maximum loss you can have is about 11% over the last 30 years. For aggressive, the maximum loss is 48% during the last 30 years. But if I just to allocate 10% of gold, which you can see in the kind of light green line. So what I did was I took 5% of the equities and 5% of the bonds and put 10% of gold in these portfolios and reran the model. And you can see what's the effect of gold just having 10% allocations. So if you look at conservative, it actually doesn't do the work because you only have about 25% exposure into equities. So having 10% might not able to reduce your maximum losses over the 30 years. But as we move closer or to the right-hand side, you can actually see the effect of having 10%. So if you look at the moderate portfolio, which we have 60% allocation in the stocks and 40% in bonds, by allocating 10% of gold in your portfolio, you actually reduces 5% losses of your total of your portfolio. So not just 5% of certain asset class, but your total asset portfolio. So that's very powerful. Just by allocating 10%, you'll be able to reduce your losses by 5%. And also, if we move close or further to the right-hand side, aggressive as well. 5% reduction if you add in 10%. So the key message here is that it really depends on your allocation to equities. From our perspective, the more allocation to equities, I think it doesn't matter what equities, because equity is considered as a risk asset. But if you have allocations to global equities, which pretty much covers all the worldwide equities, you ought to have some allocation because the hedging ability that gold plays. Now, what's the benchmark that I can provide as well? So we ran a couple of models running the same hypothetical models, looking at what's the maximum allocation you should have. Now, the chart here might look complex, but this looks at the improvement in the Sharpe ratio when you allocate gold in those portfolios. So when we talk about Sharpe ratio, it's the improvement in the risk-adjusted return of your overall portfolio. So when you talk about the risk and also about returns, how much gold I should have when I hold or when I have all these allocations. So the key here, sorry, I think it's my message. So the key is look at when the lines go flatter as well. So which means that when the line is flat, that's the maximum allocation you should have. But from our perspective, our benchmark to advise is somewhere between 2 to 10%. So if you're not sure what kind of portfolio that you have, I think 2 to 10% is the benchmark you should have. From a lot of clients we talk to, they hold somewhere between 4 to 5% as well. But obviously, if you hold 80% into equities, then we ought to advise that you hold more towards the 10% range. So it's very personal. You can have more than 10%, but as a strategic allocation, you should look at between 2% and 10% allocation in your portfolio, depending how much exposure you have in equities. So we walk through, I'll walk you through the case for gold and the strategy we can adopt as well. So hopefully that was helpful. But let's spend the last 10 minutes on the market outlook and the review as well. So for those who hasn't followed gold prices for a while, how gold has performed this year and last year. The chart we're looking at, it's some of the major asset classes performance year to date and also last year as well. If you look at gold prices year to date, which you can see in the darker shaded area, gold price is actually down about 8% this year. I think should be around 6% because I think gold price is kind of rising tonight, but it's still down this year. And you might think that's quite disappointing because if we look at commodities and risks and natural resources, it's actually up between 16% and 38%. And you might wonder why gold has actually underperformed. But we have to think back to last year as well, because if you look back at last year's performance, gold is actually one of the best performing asset classes globally. So if you look at the lighter area, gold price was up about 25% last year because of this COVID situation we had last year, and also the unlimited pumping by central banks around the world, which led to a record investment into gold. So if we look at gold prices alone, over the 2-year basis, gold actually still outperforms some of these major asset classes. If you look at global equities, it's still the best performing asset classes over the 2-year basis. It's up about 29%. But over the 2-year basis, gold is still up. So you bought gold at the start of last year, you're still up about 18%, which is far better than commodities, because commodities very, very ugly year that we saw last year. And so what's our expectation in terms of gold? This chart just look at the gold price performance since last year. So last year, gold started at around 1,500 US per ounce, and it rallied to about 2,000, which was the record high that we saw last year. And the reason why it went to record high, it's mostly because of the COVID situation, where we saw record investment into gold. People were worried about the economy, and also the slowdown in growth in the US as well. And also the dollar, the US dollar, were quite weak as well last year. So gold prices was up by 25%. Now gold price did have some correction. So if you look at gold price since last year, it actually gone from about 2,000 to about 1,700 in the first quarter of this year. And we saw this correction, you can't call it correction, but we saw this about 6% decline, about 70% decline over that period, because people were more optimistic about the economy. And also, I think the global vaccination program throughout the world did make more gold investors more bullish towards equities. So we did see some selling by gold investors in the last, I guess, in between September and March this year. But since then, you can see gold price has hovered, kind of trading between 17 to 1900, now back to 1800. From our expectation, I think 1700, it's quite a comfortable level that we can say it's a strong supporting level, because if you look at the 1700, in the last probably like 4 times that gold price has reached or gone down to 1700, it was able to, I guess, rebound when it reached the 1700. So if gold price do decline to 1700, then obviously that's a very attractive level to accumulate. So for those who might want to wait because you're a more tactical investor, you want to trade short term, then the 1700 could be a very attractive point. But if you look at gold price at this moment, so if I check the gold price right now, it's about 1780. So for those investors who are strategic investor, who already have some exposure, or they are thinking about accumulating more gold because you're worried about the economy and your equity exposure, I think the key for us is obviously is have that allocation about 2 to 10% as well. But for those who already have gold, I think the 1800, it's a very, very strong resistance level. I think the key for us is that gold, it's able to break above the 1800 and hang on onto 1800 for a while. So it remains quite a strong resistance level for us if you think about gold over the short term. But over the long term, we feel comfortable that it will break above 1800, and heading into next year, there's actually a lot of reason why people will want to accumulate gold, because I think the equity market, I think it's getting more volatility as well. And I guess as the Fed start to taper as well, that will potentially impact gold as well, but impact equities as well, because we know that there will be less money, I guess, pumping into the economy. What we expect right now is that gold going into the fourth quarter will continue to trade between 1700 and 1900. But that's the level we're quite comfortable with as well. I think there's more reason that it will receive more upsides because of the improved sentiment for gold in the last couple of weeks, given the inflation factor we're seeing, and also the dollar, the US dollar has started to weaken as well because of this, I guess, potential fiscal policies that the Biden administration will push out as well. So gold price, it's very, very important to look at in terms of the range, but it comes back to the fact that we do encourage investors to hold some gold because of the risk management tool function that it plays going forward. So if we look at, I only have 15 minutes, but let me go through these slides and I can wrap up for Q&A. But if you look at the first quarter or first half of this year, actually the gold demand is actually quite strong as well. So you look at gold demand driven by jewelry, gold bars and ETFs, which is the investment, technology, and central banks. The bright side for gold is that jewelry sector has consuming a lot more gold this year compared to last year. So in fact, in the first half of this year, we already reached about 80% of last year's total full year jewelry demand. Another bright spot to look at for gold sector is the central banks, which I cannot keep mentioning because last year central banks bought about 250 tons of gold. And in the first half of this year, central banks already bought close to that amount. So we actually feel comfortable that heading into year end or the full year of 2021, central banks will consume more gold than last year. So in fact, central banks, I think, are looking at this opportunity to accumulate gold because the pension, the investment team are looking at gold as strategic assets. And at State Street, we do talk to a lot of pension or central banks about investing in gold, and they are encouraged about the sentiment of gold going forward. So that's why central banks around the world, emerging market central banks, are pouring a lot of money just to accumulate gold as a strategic asset. But obviously, one downside that we had this year is the ETF outflows that we saw this year in the yellow shaded line. So as I mentioned before, we have some outflows from investment purely driven by ETF outflows that we had this year. I think because if we look at ETF outflows last year, it was a record inflows in the sector. We saw about 49 billion of inflows into ETFs on a monthly basis, on a yearly basis. So this year we saw some outflows, about 8.2 billion outflows. But then again, if you look at the 2-year basis, investors are still pouring a lot of money into gold ETFs as well. And why is it important to look at gold ETFs? Because it is the most transparent data we can look at to gauge investors around the world to see who's buying. So if you look at over the 2-year basis, investors are still quite long in gold ETFs in general. In fact, investors around the world are still holding record amount of gold ETFs. So you can see in the shaded area right here, how much gold ETFs by tonnage are held by gold ETF providers, including State Street. So we track about over 120 gold ETF providers around the world. If you look at the shaded area, gold ETF around the world holds about 3,600 tons as well. So even though we've seen some outflows this year, investors around the world using gold ETF are still holding substantial amount of gold. So you might be hearing about, investors losing faith in gold. People are selling out of gold because of Bitcoin or cryptocurrency. It's not true, because gold are still held by investors substantially through the ETF space. So don't get discouraged about, I guess, news that you see on the market. Investors are losing interest, potentially another bear market. That's not the case. That's not the case. Investors are still very bullish on the gold market. And I think just to wrap up, I'll just leave 10 minutes for Q&A. The demand and supply dynamics of gold will be very healthy. I think what drives gold prices, it's the investment demand on the left-hand side. Investment demand I think it's still very strong, and it's supported by the inflation worries that we're having. So investors are buying gold because the ability to hedge against rising inflation, especially in the US, we're seeing. And we are seeing more safe haven buying because I guess in the last couple of weeks, the market has corrected somewhat, especially last month as well. US equities were down about 3%. We did see some gold, investor inflows back to gold. Another bright side is that central banks will be very, very strong buyer of gold as well to support demand. Now, consumer, when we talk about jewelry and technology, that will be stable. But I think the COVID situation, the improvement has improved. So we're seeing better demand from the jewelry sector and the technology sector going forward. So if you look at three big sectors we're looking at, that it remains quite positive for gold demand. Obviously, the supply is quite important as well. Supply of gold is driven by mine production and recycle. Mine production, gold actually grows only about 2% per year. So unlike other fiat currency, it's printed unlimitedly. Supply of gold only grow by 2% per year. So gold supply will still be very limited as well. So that's why gold is a precious metals. And in fact, the world's demand about 40,000 tons, but production of gold every year is only about 3,000 tons as well. So what needs to be coming is a recycled gold that needs to be offset, that needs to contribute to the deficit of supply. So there's never actually enough gold to satisfy demand as well. So that's one thing to remember, that gold is precious. And if you ask me, how long, I guess, what's the life of gold, right, in terms of production? So if we think about, if there's no new mines that will come in today, based on the mining capacity of gold miners, for another 50 years, all the golds in the world will be mined. So that's one, I guess, interesting fact I want to share before I close off this webinar. Thank you. That's the end of my conclusion of my presentation. And feel free to ask me any questions. I can see some questions. Jason, do you want to go through the questions?
Yeah, I was looking through the question while you are doing your presentation. Maybe one of the most common questions that are asked, right, is, Bitcoin and gold. Is Bitcoin the new digital gold, and what is your view?
Yeah, that's a great question, because especially this year, we have a lot of questions surrounding Bitcoin and gold, because you look at especially Bitcoin performance, it reached 60,000 and then it's back to 30, now it's back to 60. A lot of investors do compare Bitcoin to gold because I guess when you see news in the market, investors see Bitcoin as the new gold or gold version 2. That's a reason why they say that. But from our perspective, I don't think Bitcoin can replace gold. I think we're not comparing apples to apples. I think you can have exposure to Bitcoin if you can withstand the volatility or you're looking for upside potential. But the function gold plays is quite different. I think the number one, I guess, the key difference is the risk management tool. Because if you look at the hedging ability of Bitcoin, it actually does not hedge your portfolio. So Bitcoin actually has a very high, what we call the beta to the equity market. So every time, I guess, the Nestle goes up or the Nestle goes down, Bitcoin actually, on average, moves in line with those stocks as well. So if you want something that hedge against market risk or your portfolio, I think Bitcoin does not do the work. But if you look at gold, it does do the work. And I think another key factor is the volatility as well. I think if you can withstand the volatility of Bitcoin, yeah, why not? You can, well, as an investor, you should diversify. But if you look at Bitcoin volatility, it's actually over 100% per year. So you expect you'll go up and down 100% annualized on a yearly basis. But gold annualized return of volatility, it's only about 15% as well. So all in all, gold, it's a safe haven. It's a risk management tool asset classes. Bitcoin is something you want, I guess, to get rich, or also if you want very huge upside potential. So not apples to apples, but we do encourage investors to diversify. So you can have some allocation to Bitcoin and gold, but just don't replace Bitcoin with gold because they play very, very different functions.
Thank you very much. There are also a number of questions that ask about the correlation between gold and currency, as well as, like, how does the gold affect the US, China, and Hong Kong stocks? It's quite a big question.
Yeah. I think that goes back to my question on the currency hedging. So if we look at gold's correlations to US dollar, we always use US dollar because gold is priced in US dollar. The average correlation is about negative 0.4. That's why most of the time when you see the US dollar goes down, gold prices will on average go up. Why is that? Because when the US dollar goes down, it actually makes it cheaper for investors like us to buy gold. So that's why when you see this movement, that's the reason. So if the US dollar goes up, it makes it more expensive for foreigners or non-US holder like us to buy gold. But if we look at gold versus US dollar and other currencies, on average, the correlation it's negative. It comes down to the fact that gold, it's not a fiat currency. So gold cannot be pumped, cannot be printed, right? It needs to be minted, only 2% growth per year. But all the fiat currencies that we look at can be printed as well. And I think the currency is actually tied to economic factors as well, right? So it ties to the equity market, ties to the central bank's action. But if you look at gold's diverse usage, demand, it's not, because gold is not controlled by central governments. Gold is actually, most of the demand comes from jewelry, so it's not related to the financial markets. So that's why I encourage investors to have some gold to hedge against equities and currencies, because of gold's unique properties as an investment and also a consumer goods, because they are not related in terms of the business cycles.
Okay. I think another very common question is the gold versus the gold mining companies or even ETF, right? So in your view, what do you think should investors be looking out for gold ETF or gold mining ETF?
Yeah, I think the ETFs is a great way to track the gold market. So if you have gold-backed ETFs, so gold-backed ETF means that all the shares are fully backed by gold. Basically, that's the same as investing in physical gold. So it's just an easier way to invest in gold prices. But if you have gold miners ETFs, which tracks the gold miners, that's a different story. I think if you look at gold minus ETF and gold as an asset classes, it's actually very, very different. Gold miners, based on our research, it actually outperforms gold, like physical gold or gold ETFs, gold back ETFs, when the gold price is rising. So if the gold price rise 1%, the gold miners will actually outperform the gold price because of their ability. I guess when you look at the financials, 1% increase in gold price will actually increase the share price by a lot. But if the gold price do go down by, let's say, 1%, usually the gold miners will actually underperform gold price. So gold miners is kind of like a leverage play on gold back ETFs or physical gold. So it really depends on your view on the gold market. Some of the clients of ours, they have both gold miners and also gold back ETFs, which track the gold price, because they like the dividends from gold miners, and also they like that extra leverage as well. But if you want something that can hedge against market downturn or as a risk management tool, I think gold back ETF or physical gold might be the better options to have. But it's very, very common to have both as well, because potentially gold back ETFs can hedge your downturn in gold mining ETFs as well. So very, very common to have both for investors of ours.
Right. One of the questions asked about technology. What do you refer to as technology in your chart?
Yep. Technology is a great question. So on average, technology sector use 10% of gold. So when I talk about technology, so the computers, it has certain components of gold, because gold is the best conductor of electricity. So very crucial technologies like rockets or planes, they actually have gold as a conductor of electricity, because if they have copper, for example, copper will corrode. That's something they want to avoid. If you are flying, then the wires start to corrode. So that's why a lot of crucial component will need gold as a wire, as a conductor. So technology sector use 10% of gold demand as those crucial component in the technology. So if, for example, in your iPhone, if you plan to keep it, you can actually sell it, and that's why people want to buy your reusable iPhone, because there's actually gold components in there. So if you have any iPhones that use, you can actually have a look and take some gold out of your iPhone. I think it's about $5 worth of gold in your iPhone in general.
Okay, that's very interesting to know. Okay, maybe we take one or two more questions. I think the rest of our questions are in the chat, right? We'll try to answer after the webinar. So maybe the second last question would be, apart from gold, right? Some of them ask about platinum and silver. So what is your take versus gold?
Yep. If I go back to my slides, I think, that's the slide I didn't show before. So if we look at platinum and silver, people group them as precious metals. So gold, silver, platinum, and palladium, it's precious metals. Those four commodities have very key similarities. So they have physical and chemical properties, and also they have historical linkage in monetary systems. So silver used to be a currency, and gold as well, right? But silver nowadays, people don't treat it as a silver. But 100 years ago, silver was the first currency that mankind used before gold. But actually the key difference is a lot. But so if I dig down to platinum and palladium, platinum, most of the demand is driven by jewelry. So your platinum ring or jewelry, most of them are made from platinum. So if you look at the demand driver of platinum, about 90% is driven by jewelry, and about only 10% is driven by investment. So that's very different to gold, where you have central banks, you have jewelry, you have technology and investment. And palladium, actually, there's no investment component. It's very, very uncommon for investors to invest in palladium, but the usage is quite big in industrial. About 60% is used by industrial. But then again, I think the key differences between gold versus silver, platinum, and palladium comes back to central banks. Central banks do not invest in silver, platinum, and palladium. They only invest in gold. And central banks around the world, including the Fed holds the most gold in the world. If they hold gold, if they buy gold, so that it means something. It means that they are very, very, I guess they see gold very differently versus other precious metals. I think that's one of the key major differences between gold and versus other precious metals.
Right. Ken, I think the last question of the night, maybe more of a personal question. What is your current exposure to gold? I mean, in terms of percentage, and what are you investing in, like, SPDR gold or physical gold, or combination of both?
I actually invest in gold ETFs. So what I do is, like, I have this like monthly saving plan. I'm not sure. I think in Singapore you guys have it, the CPS. So in Hong Kong we can do that as well. Is that I accumulate certain amount of gold every month, because, like, even though I look at gold price for every minute of my life, I can't predict where's it going to go, but I know what drives gold price, and I know how the sentiment compares, to say 10 years ago. So I have around 4% exposure in my portfolio. I have equities, I have bonds, I'm just an ordinary retail investor. I diversify, but 4% of that just allocated through gold ETFs, because I think that's the most effective and it's the cheapest, because gold ETFs actually track the gold prices. But then I do have some physical in terms of jewelry from my marriages. So it's locked. I think it's with my wife somewhere. So she has all the jewelry, gold jewelry that we have, but it's locked somewhere safe. But I don't know how much I have. But in terms of the ETFs, I know how much I have, because basically I can see the value every day.
Yeah, and we have some gold in our iPhone as well. All right.
Yeah.
Thank you, Robin, once again for your valuable insights. I believe the audience and myself have learned a lot through our 1 hour session. For the audience, right, we have one more upcoming webinar on investing in gold via unit trust tomorrow at 1:30. Do visit our gold landing page and register for the webinar if you're interested to join. Right, for those that have unanswered question in the chat, we'll try to answer after we end the webinar. So just wait for us to answer. Right, so with that, thank you everyone for joining us tonight, and we wish you good night, and we hope to see you soon again. Thank you. Bye-bye.